So we'll start with fundraising. As you may know, in a typical year, this is some of the data that National Venture Capital Association releases. About $20 billion is invested in across several stages of companies, and these number of companies tend to be in the 15 to 20,000 companies in a given year. So if you look at 20 billion that is flowing into companies like yours, the question that comes up is how much money is flowing into venture funds. And unfortunately, that trend has been on the downswing. So for example, in the second quarter of this year, there was only about 2.9 or roughly about 3 billion that flowed into venture funds. So if about 5 billion is flowing out of venture funds, only 3 is coming in. And if you compare the second quarter with the previous quarter, it's down by about 33%. Then when you compare the second quarter of this year with the second quarter of last year, those numbers are down by about 54%. So something is happening. Money is not flowing into venture funds from the institutional investors at the same pace as it once was. So I'm going to open it up, and Josh or Andrea, do you want to take the answers first, and then we can open it up to the rest of them?
Sure. I mean, maybe I should sort of clarify. So XG Ventures, we run it as a venture fund, but technically it's actually a super angel fund. So we're essentially our own limited partners. So maybe a two-part answer. So
in short, the entrepreneur should come and look for you because you have all the money.
Well, the initial money. But yes, anyone that would be interested in pitching, always glad to listen and lend an ear and maybe write a check. But so for us, we're super early seed stage, so we like to take that initial risk. I mean, obviously, we do a little bit of risk analysis before we write those checks, but we do take that initial risk. And we have lots of friends in the venture space, and we see our role as basically trying to groom those original seed investment deals. And because we do have operational expertise, we get in there. We get in the weeds. We help them make introductions. I help from a sales perspective. My business partner helps from a finance perspective. So we like to think that we add a lot of value and help de-risk some of these deals, so we can present them or help present them. The entrepreneurs actually can obviously speak for themselves, and they're highly talented. But we like to, kind of be a sounding board and a coach and help provide that warm introduction to the venture capital community, because a lot of times we found that they might say a polite no, but if it comes from us and if we sort of endorse the deal, it might help open those doors for the venture world.
So one way to look at this is that the capital that's flowing into companies is not necessarily impacted because super angels like yourselves are stepping up. But Josh, from your vantage point, what are some of the LP discussions that you're involved in, and how do you see this trend?
Sure. So I think that as an asset class, venture capital has stunk for a very long time. If you look at performance of venture for the last 10, 12 years, it has really performed very poorly on almost every metric. And I think one of the reasons why is because people started to look at venture as an asset class, and it's been overfunded. And so you're seeing so many, because I don't believe that venture is an asset class. I think you have a handful of funds that generate a disproportionate amount of the returns, and that's what the data says on the large side. The data also shows, by the way, that small funds have consistently outperformed large funds. Silicon Valley Bank did an interesting study. They took a look from 1982 to 2002, 20 years, every single venture fund that was raised, and then just drew a line and said, what was the median size of the fund in each year? In 1982, 1983, 1984, what was the median fund size? If you're above the median, we'll call you a large fund. If you're below the median, we'll call you a small fund. And performance was striking. Over 20 years, over 900 funds. And the beautiful thing is they were investing at the exact same time. So you can't even say, if there was a boom, everyone was booming. If there was a bust, everyone was busting. Large funds, what percent of them actually achieved 2x or more over the period? 2%. 98% did not even double your money. North of 60% didn't even return your money. So 60% of the money that went into venture funds didn't even get back to even money. Smaller funds, 48% achieved a 2x compared to 2%. So you're 24 times more likely. So I think what's ended up happening is that LPs have kind of gotten wise to two things. Number one, that it's very hard to generate meaningful returns in a large fund, and have become far more selective. And they've also become far more likely to fund micro VC funds, which I think is super angel size funds, which I think is a good thing.
So there is one thing I want to add and maybe bring the two together, which, so what does that all mean for you? You can be an angel investor or you can be a founder. And one thing that I found is the same excuses the founders are given is true for an aspiring venture capitalist. With LPs, we can't invest in you, you're a single LP, you don't have track record, you don't have enough exits. I mean, all those things I think are artificial barriers, and you need to really convince them. It's the same thing that a founder goes through. I had to build 128 versions of my deck. Probably totally failed my first LP meeting, but then I was able to do it. That's why I'm like, I can relate to both sides of the table. But at the end of the day, I think what has happened is with the abundance of companies and also abundance of funds, one thing that's lacking is authenticity and something that truly moves the needle. So there is so much noise out there that the signal has to be so much stronger. So whatever it is that you're doing, number one, it has to be unique, and it has to be 10 times better, not marginally better, but 10 times better than anything else. It's true if you're a founder and you're trying to raise money. I think it's also true if you're a venture capital fund because there are just so many of them. Maybe when Josh first got into this, the idea of a seed fund was unique. The idea of starting a fund with only one, maybe two partners was unique. And now it's not. We joke sometimes like you're going to see now like groups that like their cousins and their pets are raising new funds. I mean, there's so many. And so it's become more and more important to have a differentiation where people are like, why should I even care? And there are so many stories being told that it is that much of a higher bar to tell an authentic story, but that story to match the group that's about to execute that strategy in their DNA.
So I think the key takeaways for our audience here is smaller funds perform better. In other words, they're hungrier, they work harder, and that could be one takeaway. The other takeaway is sort of standing at least 10 times, in some axis, vertical, horizontal, in terms of the peers. As we look at, the challenges of venture funds, Aydin mentioned that most GPs or partners in venture funds have to go through the same song and dance that you do. Get your pitch deck ready, make sure the performance numbers look good. If they don't look good, you can't go in the market. And then you have to sort of do this uphill crawl on all your fours, and sometimes there's broken glass sprung on the hill. So it's a very painful journey to raise a fund. But at the same time, the smaller funds are becoming much more prevalent. And so from an entrepreneurial standpoint, there are so many different opportunities in terms of raising either a seed round or a Series A round, which brings us to the next sort of media jargon of Series A crunch. Now, this has been talked about 100 times in the past 20 panels that you've been on. If I'm an entrepreneur in the audience and I'm getting ready to raise a Series A, what should I know? What should I believe in? Is there a crunch? What should I be prepared for? Aydin, do you want to start?
Sure. I think the most important thing about Series A crunch, I think a point could be made for either side. I think the data is probably stronger for the fact that it exists. My take on this is that a lot of times, both media as well as people in the industry try to look backward and try to forecast what's going to come in the future. If you want to be successful, you can't just look at the past trends or the current trend and say, I'm going to react to it and expect you're going to be successful, right? So the way I think about it is, look, it is what it is. Maybe there's a Series A crunch. Maybe there will be 3 more crunches. The only thing that is timeless is the same thing that I said before, is having something that is really critical. Like my analogy is, look, when I was asked about Google and Facebook when Facebook went public, my simple example was if something happened in a nuclear war and each company disappeared, how would your lives change, right? When an entrepreneur comes in, I could be telling you 100 things, but the simple thing is, whatever it is that you're building, let's figure out how relevant or critical it is. If that thing did not exist today, how would people's lives change? If people don't care, then that's one metric, right? So it's the same thing for us. As a venture fund, if we're the 127 venture fund that's talking to some LP, like they're looking at us and say, like, why are you unique? Are you in different companies? Are you doing something, differently? And most importantly, also the people that you have back, can they say things about you that is different than everybody else? It's not that different than what you have to go through as a founder, and then as an angel investor as well, right? And so I think we're kind of defined by the highlights of the most meaningful things. And so if you do have the fundamentals, then the crunch doesn't really apply to you, and that's the hard reality, right? I mean, you can look at a few companies that are getting crazy valuations and crazy money, and every founder thinks they deserve that valuation and that should be them. it's kind of like if we ask across the room, or even let's start with the panel. How many of us are above average? Probably we have the inclination to raise our hands, but like clearly only so few people are in that group. So again, I think, you know, as real as that trend is, the most important thing is to kind of counter that trend with achievements in real data.
Andy, you have done about 40 investments and 20 more in the wings. When you're training your entrepreneurs and companies as they're getting ready to, you know, go out there, build their products and launch their opportunities, how are you training them to, you know, sort of make sure that they're able to get to Series A without much friction?
Right. So first off with that, if you're an entrepreneur and you have time to worry about whether there is or isn't a Series A crunch, then you're probably not someone that I want to be investing in anyway. Go talk to some customers, go execute on something, and it will be much less of a concern. So really, we're big believers in whether it's trademarks or IP or whatever sorts of barriers you've had out there or moats that you've had in the past, traction is the key now. Everything is changing so rapidly that you have to stay ahead of the curve. And you can't get lost in the irony that everyone's goal is to become that company that they're trying to destroy when they first start out. And what if that wasn't the goal and we could actually build companies that were able to adapt and we're no longer having to focus on the startups doing all the innovating, that we can have these large companies that are working together to continue to innovate. So I think that really the focus on that the bigger why behind what you're doing, the customer's problem, and continuing to go at that, no matter what product or service that ends up being, then those are the stories that keep on going, and those are the ideas that will continue to get funded.
I agree with what Aydin and Andy said. I would add a few tactical things. I would say that when I first started in this business in 2004, you could pretty much, it was actually a decent funding environment. You could count in just-in-time financing. You know, like just-in-time manufacturing where the parts show up, right? So like you could build your business, launch in January, raise money, and be out of money in February, and like it would all work. Now, what we have seen over the last 10 years is an extension of the time that smart founders are giving themselves, because you need to give yourself time to be wrong. You need to give yourself time to figure it out. The hunt for product market fit is not easy. And so the most common thing I've seen is the company goes and raises 9 months of seed capital. They're going to spend 6 months, their plan is to spend 6 months building it, launch on month 7. What ends up happening is it takes longer. They launch on month 8, and there's like 3 weeks worth of data. And the chances of them getting it right the first time are so wrong. So you have to give yourself enough runway to get it right. I'd say that the later stage investors are pretty much looking to either fund things with traction or the new shiny thing. But it's really hard to be that thing which is like a store with data. There's nothing like numbers to fuck up a good fundraise. And you don't want to be the founder that has the numbers that don't tell the story. So you need to give yourself enough time.
Yeah, it's tough to add to anything because you guys have already done a great job. But I mean, I guess I just would echo it, even in the timeline of things, when we're looking to fund a company. I mean, obviously one of the traits that we spend particular attention to and we weight it very heavily is that when we have our conversations with the founders and the team members, we like to look at individuals that have that long-term thinking. We're not, to your point, we're not looking to finance a company where the entrepreneur's only goal is to get to month or year 1 and then sell the company. The responses that typically excite us are those that are like, look, we only need X amount of money. It's not in the millions. We can do a lot with it. We're very capital efficient. We're going to go out. We're going to get the customers. We're going to get the traction. And we might turn away some of the companies that have already, by the way, pitched us. We've gotten PayPal interested in us or Google, and we love those founders that have already turned those high-profile companies down, because that shows that they have that fire in the belly. They want to grow their company to be something bigger. And then just to echo some of the sentiments we've already heard, I mean, I built my entire career on sales, and I love all of a salesperson's success is measured by how much traction they have and those hockey stick growth curves. And I think if entrepreneurs can be mindful of that, and if they can show real customer traction growth, not just showing a bunch of slides that say, oh, I've talked to Bose and PayPal and they're all beta customers. No, it's like By the time you get to Series A, this should be paying customers. You should have real revenue in the bank. And I think when it comes to negotiating those, Series A term sheets, Series B term sheets, if the entrepreneur can be more in the driver's seat and potentially have to turn away some of that money, I think it's a better thing. And those are some of the deals that we like to put our money behind, and I think they have more traction behind them.
I think you make some great points, Andrea. I mean, I think if I summarize what our panel just said in terms of Series A crunch, if you focus on execution, if you have some very crisp milestones that lead up to the Series A, and you manage cash efficiently, I think then you'll be in the driver's seat. Ideally, you want to have a competition going where you have several term sheets coming at the door prior to that day when you run out of cash. And I think the one way you can do that is obviously your numbers. I'll narrate a very simple anecdote. I was talking to an entrepreneur for a seed round, and I asked him, what do you anticipate your primary milestone to be between seed and Series A? And it took him 90 seconds to give me an answer, which was a bad thing. And then when he gave me the answer, at that point I was ready to walk away. He said, I want to hire 10 people. And so if hiring is your goal, just building a team is your goal, that is not the goal an investor wants to hear. So obviously what came out of that conversation was a little bit of coaching for the entrepreneur that this is the way you need to think about milestones. So for those who are raising seed rounds especially, I think the clarity on Series A milestones is really important. We'll shift our conversation quickly to some investing and then open it up to Q&A. A company that comes to mind is, entrepreneur walked into the door and has their products pre-sold on Kickstarter at the rate of about $50,000 a week. And the way they're pre-selling, these numbers are just unheard of. And so when you look at how investing patterns have changed, this company is now negotiating pre-money in a very high range just because of the pre-orders. And so when I look at what Kickstarter has done, what FundersClub has done, or AngelList has done, the way some of the investing patterns used to occur have changed. So the question for the panel is, how are you seeing opportunities and making investment decisions, specifically knowing that entrepreneurs have multiple options, speed is important, so how do you make your decisions and what do you look for? Andrea, do you want to start?
Yeah. I mean, these are all great tools. We are a huge proponent and supporter of AngelList. I often think it's like a voyeur's tool as well to kind of go in and check out and see who the current investors are and to look at that traction. Although the one caveat I will say is always take that information with a grain of salt. Yeah. A lot of times AngelList and Crunchbase, well now they're sort of merged together, but it's not always up to date and it's not always a true reflection of what's happening in reality. The other piece of that is Kickstarter. We've seen it with the likes of Pebble. There's a lot of companies that have basically promised a lot of things that they're going to deliver, and at the end of the day, they can't. So there's a lot of broken promises, but they're interesting tools to take a look at. But I think at the end of the day, you have to be very savvy at what you're doing. I do think you have to be agile, both as an investor and as an entrepreneur. I liken it back to my sales days. You gotta hustle. You gotta hit the streets. You gotta take as many meetings as you can. You have to be comfortable with no. As an investor, I say no a lot. As an entrepreneur, I'm sure you hear no a lot. Just be comfortable with it. Take the feedback for what it is. Grow with it. Don't take anything personally. A lot of times I stop answering email if it comes back and it gets too personal. I'm like, and I'm done. But I mean, I think that's it. Just be humble, be quick, be agile, be swift. And I think that's as much as I can add.
Josh, have you seen more of these trends on the consumer side, on the enterprise side, or
Both. I mean, it used to be that a company would come in, raise money, and then people would slowly start to hear about them. And now what ends up happening is a company starts, and you start to hear about them, and then they raise money. And it's really inverting sort of where it used to be that the VC was the gatekeeper, and now it's sort of like the VC or the investor is the person that's like receiving that signal. I would say, though, that our view is that venture is not an overly complex business, nor is angel investing. It's about finding great entrepreneurs, partnering with them, and convincing them or showing them how you might be able to be of some help or of some assistance. And that's what we try to do. Our focus is just to sort of, the reason we show up every day at First Round is to try to help entrepreneurs win. Like, that's our mission. We want to help you win and figure out what we need to do to help that entrepreneur win. And if you can be accessible, if you could make quick decisions, all of that stuff is all around like, what are the things that you need to do to just help those entrepreneurs win.
Yeah.
We've invested in several teams coming off of Kickstarter and AngelList both. I think the thing that Kickstarter has helped us with is it at least gives us an anchor variable to work off of, which are those number of units sold for how much. And the real question is, does the team understand how much money they're gonna lose off of each one of those? Because you will lose money off of that. That's not your market. And then how will that then affect your ability to actually execute on that and get that out to market? And all along that path, if you're not really looking at it in that way, then there's definitely some gaps with reality. And it's a great system to have in place. It's an awesome measure, but there's still a tremendous number of challenges in between having that idea, getting the prototype out, and actually getting to the point where you can manufacture. And it gives us some great talking points. We can know very quickly where we lie within that spectrum.
So I'll add a different perspective to it. I think one of the things that set us differently, especially after our first fundraise and going through that transition of being an individual angel investor versus being an institutional investor, is that we had to find some way that made us unique. And one thing that turned out to be very interesting for us is we have this prepared mind approach. So I think one of the best ways to be respectful of entrepreneurs and being able to give them a prompt response is having done your homework. So as a result, we do very few investments where somebody comes through the door and we decide yes or no. I think that's very arrogant. I think the better, what really worked for us is to really do our homework and say we understand what we know and what we're good at, and then try to find the entrepreneurs and companies to match. As a result, I would say about 10 to 15% of the companies we invest in are companies that never find us. We go find them. And as a result, those companies actually represent more than half of our value of our portfolio. And just to give you an example, we invested in this company called Rovio in Finland, which is another example also that not as much as great things are happening in Silicon Valley and tools like FundersClub and others have facilitated investing, there is still talent out there and it's global. And sometimes the fact that a company is in Finland or Canada and the fact that there is no VC industry or hardly any angels, just like a grape requires not to have any resources to be like a prime example, create some great companies. And those entrepreneurs actually don't need any funding. And I think to hustle and convince them to work with you is a big deal, right? So we've been competing probably against 100 other investors and funds that are 10 to 100 times our size. And one thing that we've done, it took us a 12-month courting period, but they were going to launch an online store before the Christmas of 2010, and we got them connected to a Canadian company we have that does online stores. And in 7 days, they launched that store. And that took about a half an hour phone call. Like there is this conception, some people like Josh makes it look like a magic trick. They have platform, they have incredible resources. We can help you in 100 different ways. And yet sometimes a half an hour phone call, a very thoughtful personal approach to a founder, somebody that really understands the pain point, can make a big impact, and founders really, really appreciate that. And I think it was that difference that made us one of 3 investors universally that were able to invest in that company that actually didn't need any money. And I think it's representative of our unique approach.
Thank you. We're going to open it up for questions. If there are any questions in the audience. Yes.
Yeah, Aydin, your diversity in your partners in your firm kind of spurs a question that I have. So in my day job, I work for a company in Cupertino that runs a big app store. And a couple of the disproportions that I notice is what I can see in investment or development of applications in said store is very, I'll call U.S. Western culturally relevant. So it's got a high disproportion of applications developed for those particular users. At the same time, there's a very high disproportion of growth that's actually occurring in other markets. So along those lines of things, we have the next 500 million users that are coming online that we can see love to use apps, but there isn't an inventory and a proper selection for them because the investors are not investing in those markets. So I guess question for all you guys is what's your take on that? And do you see the traditional Silicon Valley investors being involved in that next stage of digital revolution that's going to occur in markets outside the US?
I think one quick comment that I'll add to that is there's been this traditional approach like, hey, what's a hot country? China, India, Brazil, and venture approach has been, let's go do a fund for that. We're KP, let's do an iFund because iPhone is the next cool device. The way we think about it is it's not that, it's I think doing it in reverse. You should have a great company and where they are is not important, right? In the same way, the reason why we have a very diverse team is not like we're charitable people and we like to give opportunity to disabled people. It's more like, you know what, there is something healthy about having 6 different people from completely different backgrounds. What good is it if you walk into a venture firm, everybody dresses the same, everybody looks the same, everybody talks the same, everybody's on their iPhone or BlackBerry not paying attention to you typing the email, and we, on the other hand, had to work for every single thing that we got. Because we're immigrants, we have to be twice as good and twice as fast. We understand what the founder is going through. And you know what? Even our Silicon Valley companies come from 35 different countries. The first thing they see when they see us, these guys are different. So when we say we're different and they see that, it reinstates. But also it takes away biases, right? I mean, as human beings, no matter how smart we are, we have personal biases. And if you have 6 different people, we hope that the biases will cancel out. And we've seen some really incredible things. And as a result of that, we've been able to appreciate some of these things. In hindsight, it looks perfect. Now you can look at Arovio and say they have a 1.2 billion downloads. When we talked to them, they had 12 million downloads. And I think because of our experience, we were able to appreciate why they were going to be significant, rather than just looking back and say, oh, these guys are really successful. Let's go try to find like a way to get into that. That's not going to work because you're going to be seen as a follower and not somebody with an original idea.
The important thing on any of those is really understanding the why behind what you're doing. If you can have everyone focused on that and not worry so much about the what and the how of the execution, then the diversity becomes a part of how you do business. We don't have a particular focus for the fund in those areas, as you said. You know, we're not an iPhone thing, but since we are very community focused and have that diversity built into what we're doing, that message connects with a much broader spectrum of individuals. And this is what has allowed us to end up with 32% of our teams that have a female co-founder. Now, that wasn't by design. It's not something that we target. It's just how that happens when you have that messaging and you have others coming that share it.
Other questions for the panel?
Hi, my name's Eamon Leonard. I'm from Ireland. This is my favorite panel of the day. Thanks very much. So I've been a founder and I'm an amateur, very amateur angel investor back home. And you're talking about the Series A crunch. Well, we have an angel crunch. Where people aren't even getting as far as Series A. That's a luxury. Well, it creates an ecosystem, an environment with founders with a lot of hustle, a lot of hunger and desire to be successful. What we're really missing in Ireland is not just angel in terms of in dollar investment, but also the mentorship that comes with that, right? And that's been mentioned a couple of times today. What I would like to do is actually raise a hybrid fund in Ireland, very small focus on that kind of early stage. And by hybrid, I mean of local investors in Ireland, but also here, and it'd be a kind of a route to the valley. So my question is that something you've ever seen? Have you ever seen it worked out? Are there any, off the top of your head, hints or tips you could give me to make that something a reality? Less than 5 million.
Haven't seen anything directly. Just keep in mind that the ecosystem is going to be the key. The funding will be a part of that, but if you don't have the rest of the foundation in place, you'll end up with a angel glut, and the community won't be able to come together to innovate enough to have new ideas. So I think focusing on the fund is probably not the best way to go about it. And if you can really build up that community and get that support and momentum behind, then you make sure the funding is available. And you can do that on a pretty small scale to start building up some pretty powerful momentum behind what's happening.
I mean, I would say, I think in general, I hear this question a lot on both sides of the table. Like, have you seen this work? Is this going to be great? I think as a human nature, because maybe we've been chased by dinosaurs in caves, we kind of have this risk-averse approach. And If there's anything that I learned is actually like embrace that unique thing and make it work. If there's a product market fit and you put your effort behind, you can make anything work. It just has to be something that moves the needle, right? I mean, I've invested in close to 10 countries, but I've probably seen 40, maybe 50 with Google. And the one thing that I see is like, you can always see some creativity. I mean, there is some crazy Facebook soccer gaming company in Serbia that's making 100 million EBITDA. 95% of people I know have never even heard about it, right? So you can say, wow, that's war-torn country, no resources, no mentor, no capital, and somebody like with an idea that like resonates comes up and builds a company like that. And every single thing that you see is like somebody came up and against all odds, they just won't stop because they really believe in that mission. So if you can, again, find that unique aspect that moves the needle and capture that, and I think and back people like that, then I'm sure it can work.
And I think the guys at Plug and Play have also done this in some creative ways where they've brought in entrepreneurs from other parts of the world and found ways to at least get them some angel funding. So maybe after the panel, we can share some contact details.
And it's great to have Patty Cosgrave, by the way. I'm going to Founders for the second time. It's third time for our, every country should have a Patty.
One last question. Simon?
Hey guys, I thought it was great how you each talked about your individual value added as a VC or angel. And Josh talked earlier about the democratization of entrepreneurship. With crowdfunding, the talk has been so far about sort of crowdfunding leading to VC or whatnot. Maybe if we talk about the democratization of angel investing or VC, how will that affect firms that aren't providing value add?
So just to make sure we understood the question, your democratization of angels, and that's better compared to VCs who are not necessarily value-add VCs, because there's a shift going on in the ecosystem of angels as investors, VCs as investors, and angels can be better. Is that what you're saying?
Essentially, I think we were talking earlier about Kickstarter leading to great investments for the panel. And it's great because you guys can all add value add to these companies, but in the cases where Kickstarter can sort of replace VC, how do you think that trend will
If Kickstarter replaces VC. So
Very well,
if online models replace VC, what kind of value add do we see happening to entrepreneurs?
I think entrepreneurs create great companies, not venture capitalists.
Yeah.
Right, so that if Kickstarter ends up, my first answer would be if Kickstarter ends up eliminating the need for venture capitalists, I think that could be a good thing for the entrepreneur and a good thing for the industry because, a good thing for entrepreneur and it removes friction. That said, experience shows that when companies achieve scale, my experience has shown that when companies achieve scale, there's one thing to sort of find product market fit, which is getting far more capital efficient, and then you look at the amount of capital it takes to grow beyond that, right? So you could look at what a Facebook or Twitter did to find product market fit, and then the hundreds of millions of dollars they needed to grow beyond that. So my sense is that what you might find is, is that the Kickstarters of the world, or the angel investors of the world, or the clubs of the world might take some of that early risk, and I'd say some of the seed funds of the world will take some of that early risk, and it makes it easier for the venture investor to have a curated group of opportunities to fund, albeit at a more advanced, less risk, higher price.
I mean, look, this keeps coming up again. It is the example of just because Zara and H&M exist or Gap exists, Prada is going to suddenly die tomorrow. And in fact, both sides of that is thriving. I think it's the same is true for venture capital. As much as we like to talk about scale and disruption, the venture capital business itself doesn't scale really well. It's, I think, a very boutique business. I think Josh is one of the few people that is building a platform and trying to make it scale. But in general, that's the reason why I can stand out here and I'm like, you know what, the kind of stuff that we do, it's not going to be done in a platform. I think overall it's great for so many companies. And actually, it's also very good for angel investors because I remember when I first started, I kind of needed to do the master and apprentice model. I remember spending time with Josh and Ron Conway, and these guys are like very respected and going out there making investments. And I'm an ex-Google guy, but what do I know about angel investing? I talk to great people, and I kind of had to pay my dues and get into deal flow with other people. Today, you can start. You have LinkedIn. You can double check everybody. You have Crunchbase and AngelList to do your homework. You want deal flow? Well, you can at least get access to companies wherever they are, right? I mean, the one thing that I always tell people, and it's true for founders and investors, you know, like there were probably like 10 Finland-focused funds and angel groups and whatever, and yet here we are, like me being from Turkey and having an office in Palo Alto, I can go find the best company in Finland. There is no barriers to entry, right? I mean, that's one of the things. As you have these facilitators, with the democratization comes the aspect that the signal has to be that much higher.
Yeah,
and to the extent that you can engineer it, you can have success.
One final word. We were the seed investor in Uber, but right alongside of us, they listed on AngelList, and they raised money off of AngelList. So again, it goes to show that the opportunity to get into these what I think are going to be world-changing companies exist at both the angel and the venture level.
Please join me in thanking our panel.